Welcome to this video on understanding your risk insurance policy. What I want to talk to you about today is the elements that you will see on an insurance policy or a quote. And these are very important to understand because often these are the little areas where people fiddle around and suddenly it looks like you're paying way too much for your current insurance and you could be getting it a lot cheaper at another provider, but you're not comparing apples with apples. And understanding the elements of an insurance policy is important. So let's start with something called the premium pattern. The premium pattern is the way that your premiums will grow over time. There are a few basic patterns. A level premium pattern just means that your premium stays the same as long as your cover does not change. That means that only when the actual level of cover increases, say from R1 million to 1.1 million rand due to a 10% increase, then you will see a corresponding increase in the premium. If the 1 million rand insurance stays 1 million rand year on year throughout the term, your premium will stay the same. That is a level premium, and it's the easiest way to compare the cost of insurance between two insurance companies. The next type of premium pattern is an age-rated premium pattern, which basically means that even if your insurance does not increase, the level of cover does not increase. Your premium will increase the older you get, because the older you get, the higher the risk of you actually claiming against your insurance. So what this means is if your insurance is R1 million in year 1, you will pay 100 rand. If it is still R1 million in year 5, you might be paying 200 rand for the same level of insurance because you're 5 years older, your risk of claiming has increased. And this can increase substantially over time. This type of insurance is not, or this method of structuring insurance is not my favorite method when it comes to making provision for things like estate duty and executors fees, where the policy is expected to run throughout the life of the client. Age-rated can, however, be beneficial when you're covering for a specific event such as for debts, where you're going to be paying something off in 5, 10 or 15 years and you want to pay the lowest premium now. Because typically for R1 million insurance, your level premium will be higher than your age-rated premium. But there will be a point in the future where you will actually start paying more on an age-rated basis than on a level basis. So talk to your financial planner about structuring your growth premiums or your premium growth correctly. Secondly, there is a thing called a guaranteed term on all policies, and this is a term that refers to the amount of time that the insurer who issued the policy guarantees that they will not change the costing of your cover. In other words, a 15-year guarantee term means that your premium will only grow according to the premium pattern that you have chosen. But after 15 years, if the underwriting assumptions on which they base the decision to issue your insurance has changed significantly due to claims experiences, there is some kind of new disease in the world that is resulting in high claims, they reserve the right that after 15 years they can reprice your insurance and charge you more for the same amount of insurance, and then it will normally continue for a 5 or a 10-year period guaranteed again. It is important to understand this because there will be a difference in price for a shorter guarantee term versus another policy or another provider that offers a longer guarantee term. You even get some policy providers that will issue a policy with a whole life guarantee term. Normally that premium will be a little bit more expensive. Now if you're not aware of these differences, you might think that one provider is significantly cheaper, not understanding that the risk is that your policy could be reviewed in 10 or 15 years' time and completely repriced. It's important to match your guarantee term with a specific need and the reason you took the insurance out, so talk to your financial planner about guarantee terms. The last thing that I want to chat about is cover end dates. Certain benefits have cover end dates, meaning that the cover is provided for a specific period after which you will no longer enjoy cover, and this is typically on disability type benefits. Disability benefits, depending on the insurer, can run up to maximum age 65 or 70, and the reason for that is that your working life is generally not expected to be longer than 65 or 70, at which point you go into retirement. Once in retirement, you cannot become disabled because you are not actively working. You are normally then dependent on a passive source of income. So ensuring your ability to earn an income is not necessary. You get other types of insurance where you could, for example, just put a term on your life insurance. This might make sense if you're insuring for a debt that covers over a specific period and after which it is expected to be paid off. But not knowing the difference between comparing a whole life benefit versus a term benefit also means that there could be a significant cost implication, and one could be significantly cheaper than the other, but you need to understand why. So understand the structure of your policy and know how to compare apples with apples. Talk to an independent financial advisor about getting your comparisons done properly. Thank you.